Alan Auerbach will be giving a review of the issues, and then there are four of us as discussants. Following Jim's procedure, I'll be residual claimant, and the discussants will be in alphabetical order. So with no further ado, why don't we get started? Alan.
Thank you, Roger, and thanks very much to our hosts at the Becker-Friedman Institute for hosting this very interesting conference. This is a long title, and there are a lot of capital income taxes I'm going to be talking about. And not to pull a bait and switch on you, but even though I raised a question this morning about Warren Buffett and his secretary, the main reason why Warren Buffett has a lower tax rate than his secretary is because of the capital gains tax, which I'm not going to be talking about. What I am going to be talking about are three general areas / questions of capital income taxation, the choice between which have been quite prominent in the literature. The choice between income and consumption taxes as main broad-based tax, corporate taxation, and wealth transfer taxes. And you might think of these as going in order of aggregate importance in terms of the corporate taxes the taxes that we collect. The income tax accounting for about half of the federal revenue in the U.S., corporate tax perhaps 10%, and wealth transfer taxes a small tax, but interesting for a variety of reasons, not the least of which is that they're paid by very, very wealthy people. When I'm talking about income and consumption taxes, the first topic, I have three sub-topics I'm going to cover. First, thinking more deeply about what we mean when we talk about capital income. So focusing on the tax wedges implicit in different tax systems, how the timing of income affects tax payments, and how we can break down the different components of capital income in thinking about how we want to tax them. Then I have to say something about important area of recent research, which one of the panelists, Mike Golosoff, has been a prominent contributor to, the new dynamic public finance, which certainly relates very squarely to capital income taxes. And then finally, in this first section on income and consumption taxes, I wanted to talk about the very active area of behavioral economic research in recent years, because questions of capital income, saving, and so forth have been one area that this research is related to. And I think it's, as yet, it's certainly recognized as an important consideration in tax design, but hasn't necessarily found its way into proposals. So on the first of these subtopics, tax wedges, timing, and components of capital income, we start, if one wants to start from where the literature starts, or at least the modern literature starts on these topics, on this topic, there are really two strands of contribution, one of which has already been cited this morning, the Atkinson-Stiglitz results saying that under not completely general conditions, but under reasonable conditions, you might not wish to tax capital income. And then the Chomley-Judd result, which says if you, with a sufficiently long planning horizon, capital income taxes become very, very distortionary. So you could think of these, each of these strands of the literature as leading to recommendations against having capital income taxes. The arguments are different. The first argument is they're not that helpful when you have other instruments available, and so you may not need to use them. The other is they're very, very distortionary, and so you want to rely on them very, very little. But what's developed in the years since these important contributions is that there are many additional subtle points to consider. And so I'm going to talk about some of these. Now, of course, one issue that's often associated with capital income taxation is dynamic inconsistency. The fact that government has a clear incentive to say one thing and do another after some time has passed. And this is, of course, a concern when we think about the capital income taxation as well as other government policies. That basically, when people have made decisions that lock themselves into particular positions, the government, which may have wanted to tell them it was going to impose low capital income taxes, that once they've saved, will then find that with the capital sitting there, that it can be easily expropriated with no apparent efficiency costs, of course, with efficiency costs in the long run that some other government may worry about. Now, one of the interesting things about this is that we worry a lot about it when we talk about capital income taxation. And yet, if one thinks of examples, at least for the US, where the government has changed tax policy, it might be easier to think of examples where the government has gone in the opposite direction. And a classic case is the Tax Reform Act of 1986, where the federal government reduced investment incentives, lowered income tax rates, which, and I'll come back to this, has the effect of reducing the tax on existing assets relative to the tax on new assets, which is exactly the opposite of what the dynamic inconsistency problem would lead you to expect. On the other hand, when one thinks about consumption tax reform, one of the things that we recognize in the literature, and I mentioned a paper here that I did with Larry Kotlikoff and John Skinner using a general equilibrium model of the type that Jim Heckman referred to this morning, is that there are big differences in the treatment of existing assets depending on exactly how you impose a tax that doesn't tax the income on new capital investment. And people used to think that taxing labor income, that is simply not taxing capital income at all, and taxing consumption, which if the tax rate is constant over time, effectively doesn't tax the returns to new saving, were pretty much equivalent. And they recognize perhaps that they differ in transition because consumption from previously accumulated wealth would be taxed under a consumption tax, not under a labor income tax. But it turns out that this is a really big deal. If you look at the difference in government revenue, if you look at the implied efficiency of the tax system under a transition to a consumption tax versus a transition to a labor income tax, you get huge differences in long-run GDP, in economic efficiency, to the point that the differences between these two tax systems, the difference is far bigger than the difference associated with the efficiency gain from not taxing capital income. That is, we used to think that when we think about a capital income tax, we might have an efficiency gain by removing the distortions of intertemporal choice. That's true, but it turns out that the effect of gains in economic efficiency associated with that are small by comparison to the differences in outcomes depending on how you make the transition. And that brings us into more squarely into a discussion of the fact that it's useful to think about capital income's components. That is, we might in simple economic models have some rate of return that's taxed at some rate, and that is capital income, and it's facing the capital income tax rate. But actually, what we typically call capital income, and what our tax system treats as capital income, has many different components. And these components, under certain tax systems, could be treated differently. And their behavioral responses are different, and for a variety of reasons, we might want to tax them differently. So among these components are quasi-rents to old capital, which is what gets picked up by a consumption tax and which makes a difference in the simulations I just mentioned. Economic rents, that is, returns to businesses that cannot easily be attributed either to new investments or existing investments. Disguised labor income, particularly in the case of entrepreneurial enterprises, companies that generate a lot of what appears to be capital income. The capital income is occurring because of labor contributions. And finally, compensation for risk, the fact that assets yield, on average, higher rates of return because they're risky. Now, a consumption tax, which in the Burley's Review's nomenclature is EET type of tax, that is not taxable, exempt from tax when saving is done, exempt from tax as assets accumulate, taxable when money is withdrawn, which is the way we traditionally treat pensions in the US. Hits all of these. Labor income tax doesn't hit any of these. And so these four components are treated differently. The only thing that's treated the same is the safe return to capital. So if we think of new capital investment yielding a safe rate of return, which might be quite low, it might be a treasury bill rate, plus a lot of other components, returns to risk, rents, disguised labor income, and then the business as a whole yielding higher income still because of returns to existing assets, it's really only that return to the safe rate of, that small component, the safe rate of return, that makes a difference. That is treated differently under these two under, say, the wage income tax and the consumption tax rather than the income tax. So basically, an income tax taxes all these components. A consumption tax taxes all these components except for the safe rate of return to capital, which leads one to ask how much of a difference a tax on the safe rate of return to capital might make. That is, when one delves into this literature, you're compelled to ask the question, well, if the real safe rate of return is 1% or 2% or 0, are we really arguing, when we're talking about capital income taxes, are we really arguing about whether the tax on that component should be 0 or some positive number? And indeed, there may be other reasons for taxing it. For example, we talked this morning about age-based taxation. There are various papers in the literature suggesting that if you can't have age-based taxation for some reason, that indirectly you may wish to tax capital income to the extent that capital income has incidence that differs by age. So you could even come up with reasons for taxing capital income, that small component, and then the other components of capital income have different arguments that affect it. Some of these are, when we're thinking about how to tax them, the flexibility of converting labor to capital income might be an argument for taxing components of capital other than the capital income, other than the safe rate of return at a rate similar to labor income, which is what happens under the EET approach. Whether risk pooling is efficient in private markets. If not, there might be reasons for taxing that. Depending on the mobility of rents, if we're really talking about fixed economic rents, there's a strong reason for taxing that. Less so if what we call rent is really something that's a return to a factor that's mobile. Moving into the second subtopic under consumption taxes is yet another argument for capital income taxes. The new dynamic public finance says, if we think about the role that capital income taxes play in a Murley's income tax world extended over time, then the Murley's world and the ability to impose progressive taxation is constrained only by self-selection constraints. That is, not putting taxes on high ability people that are so high that they essentially go on strike and don't earn the income that we want them to earn. And one of the key insights from this literature is that you want to make sure that people who turn out to have high ability also have a lean and hungry look. In particular, that they don't have assets to fall back on and to enjoy a enforced but relatively pleasant retirement from the labor force. And this is an argument for having capital income tax wedges. And the literature emphasizes the word wedge rather than tax rate, because all it's really talking about is disturbing intertemporal optimization conditions that people have. And one of the things that some of the papers in the literature have pointed out is you can achieve this outcome even having average capital income tax rates that on average are 0 if the tax rates vary according to the state of nature, the economic conditions. Now, of course, the results suggest a tax system that seems kind of strange, which is you want to have pretty high taxes on capital income and bad when the situation is kind of bad. Because that's when that's the situation where you really want to make sure people don't pull out of the labor force. But nevertheless, it's certainly I wouldn't say a cautionary tale, but it's certainly a complication that reminds us that the old basic results saying capital income taxes, even that's taxing the safe rate of return should be 0, are too simple. And the final topic I wanted to talk about in this group of this first area, which is consumption taxes versus income taxes, is tax salience, inertia, self-control, targeted saving, all of the terms that come up in the literature of behavioral economics. Now, behavioral economics or in behavioral public finance focuses on a variety of things that people do where we think they may be prone to make sort of the wrong decisions for a variety of reasons. Saving is an area that has been highlighted, and I think there are a number of justifications that people writing in this literature give for this being something where people might be messing up. First is it requires long-term planning. So you've got to be you really got to have a long horizon in thinking about what's going to happen, and you've got to be willing to delay gratification. So you're saying, you know, you really shouldn't enjoy that income now. You should put it away for 40 years. That's a difficult decision for people to make. Second, and related to this, the trade-offs are difficult to understand. There's an industry of financial planners and financial advisors. Economists, when reviewing some of the recommendations they make, think that they too may not understand what's going on. And in any event, or at least some of them, because they vary a lot in quality and sophistication, and nevertheless, whatever advice they give is only given to a small group in the population who may not follow their advice. This is not an area, we don't train even, train even college graduates from very good colleges to do these kinds of calculations. So unless they major in economics and finance or somehow get a job working in one of those areas, they may be very, very naive in terms of what are really very central economic decisions. And then finally, there's a limited opportunity for learning. You may discover when you're 65 or 70 that you made woefully bad decisions when you were 25. It's very hard to do anything about it. And so you can transmit your wisdom to your children and grandchildren, who undoubtedly will be hanging on every word. So what are the implications from this kind of mistakes in optimization? Now, it depends on the model. One of the problems we have in this literature is that it's sort of a developing literature, and it's easy for economists to assume optimization and full information. We then have a lot of predictions. But when we say people are making mistakes, that sort of opens the door to, and we have to describe, and we try in still rigorous manner to describe how people are making mistakes. But there are many different ways of describing incorrect behavior or so-called irrational behavior. And so depending on the kind of mistakes people are making, you might want to subsidize saving because they're not saving enough, because they're too myopic, but you might also not want to subsidize private saving if that's simply giving them more resources to allocate incorrectly when they have meltdowns and just spend everything they have. And a more I think a lesson that we've taken from, and that some papers have suggested matters, is that if you really are myopic, the timing of your tax payments matters. So this distinction between the labor income tax and the consumption tax has another difference that arises, which is that even if we think the present value of taxes on the safe rate of return, being zero, is the same whether you get a deduction when you put your money into an account and then pay tax when you take it out, or get no deduction when you put your money in and then pay no tax when you get the money out, those may have the same present value using a market interest rate, or even the interest rate available to the individual in question. But if the individual effectively is discounting at a very high rate because of myopia, that can suggest that you might essentially be able to trick the individual into thinking he's getting a better deal from saving than he actually is by giving him more of the tax benefits up front. Another implication is that if you can't using the tax system at all to change saving may not be the right approach, to the extent that people's responses to tax incentives may be imperfect. They may not understand what incentives they actually face. But employer organized activity, employer provision, or saving organized through employers may be an alternative way to go. And you even get a funny result, that if we were to move to a tax system that favored saving more generally than our current one, which focuses tax benefits primarily on certain forms of saving, like employer-provided pensions, we could actually have a decline in saving to the extent that employer-organized activity might be reduced, because employers would not have as much an incentive to provide this benefit for employees because they could get it on their own. But of course, if they could get it on their own and then choose not to take advantage of it on their own, you could actually have a decline in the saving that occurs. And in general, and this gets back to an issue this morning about picking winners and having different tax treatment for different kinds of activity, our standard models tend to tell us that treating different kinds of saving differently doesn't make a lot of sense, can be distortionary. But if we've got a world in which people think about retirement saving and the money in that account is somehow segregated from the money in another account, even if the underlying money is fungible, and that causes them to alter their behavior in a direction that we think is good, which certainly sounds like paternalism, then that might be something we want to do. And you really can't, when you're thinking about behavioral economics and behavioral public finance and its implications for tax policy, it's extremely hard to avoid paternalism. You have to take a stand on what you think is good or bad policy, and that makes or should make people uncomfortable. Because in the same way that choosing different tax rates on different commodities might be a good thing if you're using the Ramsey rule, and a bad thing if you're using the Boehner rule or whatever the rule happens to be, the same thing could be true here. That is, the excitement about so-called nudges in the tax system or government regulation in general suggests that we have a benevolent government putting these nudges into and these various schemes into place to make people do the right things. And what the right things are may be a matter of opinion. So the summary so far is that capital income is different from labor income. Now that's, I guess, the main point I tried to make this morning when talking about Warren Buffett and his secretary, that it's not, one shouldn't really think about an income tax as sort of a starting point for the tax system, a general income tax. The tax rate on the normal return to capital, which continues to occupy a very important place in a lot of the theoretical literature of capital income taxation, is actually a very small part of overall returns to capital income. And of course, the conclusions about an optimal tax system depend critically on what motivates individuals to save. Now, on corporate taxation, since the single most important contribution in thinking about the corporate tax, or a couple of them, were by Al Harberger, and we're in Chicago, you can just mention that and then say we have moved on since the 1960s. There's a lot that's happened since Harberger, and they're in two dimensions. First of all, economists continue to think, and so we've got new theory and new evidence about the corporate income tax. But also, particularly in this area, we've got a changing economic environment. That is, what the corporate tax applied to and how one might want to model the corporate tax 50 years ago is quite different than today. And so different issues arise. Now, as before, as in thinking about the income versus the consumption tax, the components of capital income matter. Here, for example, it matters what the sources of finance are. Are we talking about debt versus equity finance, retained earnings versus new share issues? For both debt and for retained earnings, through the so-called dividend tax capitalization view, we've had various suggestions that the corporate income tax doesn't really impose any kind of a burden or distortion on new investment, leading to a view, maybe a few decades ago, that the corporate tax applied distorted decisions on a much narrower field, that is to new equity investment, not to all corporate capital. Now, there's another distinction, and this is perfectly analogous to the discussion between the distinction between consumption taxes and labor income taxes, which is that you can change the tax burden of a corporation or other business by changing its tax rate or by changing the provisions associated with its new investment. And investment incentives are associated with lowering the tax on new capital, and reductions in the tax rate are associated with reductions in income from all capital, including new and old capital. So how you manipulate these two sets of these two provisions, investment incentives and the corporate tax rate, affects the relative burdens that you're imposing on new and old capital. And indeed, the example that I gave you from the Tax Reform Act of 1986 was earlier was one where we reduced the tax incentives for new investment, lowered the corporate tax rate, which was a transfer of the tax burden from existing capital to new capital, which goes in exactly the opposite direction in terms of long-run economic efficiency. In terms of the current policy discussion, we are actually talking about moving further in that direction. The most common tax proposals in Washington actually are to lower the corporate tax rate further and further reduce investment incentives. There are certainly economists who have expressed some concern about this, but that's certainly not the loudest voice one hears. Now, in terms of the evidence on the responsiveness of businesses and their bond and debt and equity holders to incentives, there's certainly strong evidence. And if we're thinking about investment, strong evidence, especially in cross-section in terms of the composition of assets, perhaps less so about long-run investment incentives, that is, if you look at the time series. So we know that there's substitution. It's less clear that there's actually big changes in aggregate investment. On the side of the corporation, we have evidence both with respect to dividend policy and borrowing, which on the one hand recognizes that dividend policies do respond to changes in dividend tax rates. We have important evidence of agency effects here. That is, companies are more likely to increase their dividends when dividend tax rates go down if the executives, taxable executives, have a big stake in the company, or if there's large taxable shareholders, which suggests that a shock to all that companies aren't always acting in the best interest of their shareholders. On the borrowing side, we also have evidence that the effective rate at which companies can deduct interest payments determines how much they borrow, as our theory says they should. But again, we have also some evidence. There are so-called agency considerations here as well, in particular that companies may not be borrowing as much as would maximize shareholder value because the interests of shareholders to do so may be inconsistent with the interests of managers to not have such large interest payments to have to meet every year. And here there's an interesting sort of a thing that follows on from that, which is that we normally think that managers not acting in the interests of their shareholders is a bad thing. But in the case especially of the interest deduction, which is something that certainly could be reformed so that there was a more equal treatment of debt and equity, the fact that managers may borrow too little from the shareholder's point of view may actually be good from a social perspective. That is, if we think companies have an incentive to borrow too much because of the tax benefit for borrowing, and managers don't borrow as much as shareholders would like them to for reasons that have nothing to do with altruism or social conscience, the fact that they're doing it for the wrong reason doesn't necessarily mean that they're doing the wrong thing from a social point of view. That is, we might think that provisions that increase shareholder rights, such as potential leveraged buyouts, which increase shareholder value, might actually be bad from a social perspective if we think that the borrowing is being too heavily subsidized. This is an extreme second-best argument, but it's nevertheless one that's quite relevant in the practical policy sphere. The changing economic environment, two facts about the corporate sector in the U.S. I'll use her numbers; they're more favorable. about the corporate. Two things about corporate sector in the U.S. One is that the corporation is declining. It, by recent measure, now accounts for only about half of all the business income in the U.S. On the other hand, the multinational corporation is rising. So whereas the corporate sector has shrunk relative to the U.S. economy, the share of corporate activity accounted for by multinationals is much larger than it used to be. So that is, if you go back to 1960, most business income was corporate, and a lot of it was in companies that only produced domestically. Now, a lot of those domestic-only companies are not traditional corporations at all. But what's left in the corporate sector are multinationals. And that's important because if we think now about the corporate tax, there are a lot more margins to consider because we're now not just talking about domestic decisions, but also allocations of activities across borders. And this yields another argument, starts giving us another argument against capital income taxation because of mobility. Companies may be generating what appear to be very high rates of return in the U.S. We might be inclined to call that a rent and say that's something that we can tax. And maybe if the company couldn't operate in another country, that would be true. But if the company can shift its operations abroad, that may be harder to, or less argument for imposing a tax on it. And of course, capital isn't, and these sort of rents to the company as a whole aren't the only thing that moves. The electrons controlled by accountants and financial planners also move. That is, by changing financial statements and various measures of where expenses occur and where income occurs, income can be moved around the world without anything really much going on underneath. And this is another cause for thinking about different components of capital income. I'll just say, I'm going to skip ahead to say a couple things about wealth taxation in my remaining time, so I won't be able to go through all my slides, but just say, when thinking about taxing multinational corporations, it's really hard to know what the optimal tax system is. So whatever pretense we may have that in a domestic context we've come up with some optimal tax system which includes the optimal taxes on capital income, it's really complicated when you have so many margins of choice in the international context. And you also have to take into account the fact that other countries are choosing their tax system too. So it's a strategic, there's a new party. It's not just the government versus the taxpayer. It's also the government versus other governments that has to be taken into account. So just to say a few words about wealth transfer taxes, we often start by modeling these as just periodic versions of capital income taxes. That is, you can either tax capital income on an annual basis or you can tax it every generation. But either way, you're taxing capital income, you're discouraging capital accumulation, and so it sort of looks the same. And so you might say any lessons you draw from what capital income taxes should be, you can also apply those lessons to wealth transfer taxes. But there are important differences that we need to take into account. First, there are great difficulties in administering taxes on wealth transfers. There are uncertain lifetimes, and we don't really have a complete annuities market, and as Wojciech has pointed out in one of his papers, wealth transfer taxes essentially amount to annuities because you only pay them when you die. So you essentially have more resources when you're alive than when you're dead, which is what annuities do. And so wealth transfer taxes might have a efficiency improving effect in that sense. Different individuals are involved. You can model lifetime capital income accumulation as a decision that only affects one person. Maybe that's not right, but you can certainly think about it that way. You can't really do that with wealth transfer taxes because the whole point of wealth transfers, unless they're accidental, is to transfer resources to somebody else. And that brings in the role of intergenerational persistence of inequality. These are all of the issues that come up in the paper as I talk about wealth transfer taxes. So I encourage you to look at the paper because I'm not going to have time to talk about what I say. So I'll move ahead to the conclusions for the paper as a whole. Perhaps the most important thing I have to say is that these first 2 points, capital income has different components. So our tendency to model capital income as being the rate of return, and then we think about how to tax that rate of return, is not just a simplification. It's a gross simplification, and it really leaves a lot of questions unanswered. Capital income is different from labor income, and this perhaps is the most obvious point, but also the biggest obstacle in translating what we say for the policy discussions, because those discussions, I think, still have a tendency to start by saying, why isn't income all being taxed at the same rate? The intertemporal consumption decision is one of many. We haven't fully integrated administration and enforcement into our optimal tax models. Certainly there's some of that. It becomes particularly important when we're thinking about complicated things like multinational corporations and wealth transfers. I just raised the issue of agency issues with corporations, which are relevant for taxes related to corporations, and then the decision-making people make in making savings decisions. In general, as you get more complicated, adding generations, adding behavioral considerations, adding other countries, it becomes a more daunting task to design capital income taxes, but not a less important one.